I have here my special guest, Michael Soares. Is it Soares?
Yeah, Soares,
Soares.
Soares. Yeah, depending on where you're from, but it's all
So
good.
he has come out with a book a couple months ago, I believe, and it's What to Expect While Investing. So I have him here to kind of give my audience his point of view of how people should start investing, what to expect, and yeah. So here we go, Michael Suarez. Let's get at this. How you doing, Mike?
I'm doing good, man. I'm doing good. How you doing?
Good, man. Good, man. I'm excited here. We can talk, and you can kind of give some advice to my audience of if they're interested in getting into investing, what they could expect getting into the market, right?
Yeah, absolutely. Yeah. So that's
How long
that's
have you been doing this? Let's start off with that.
yeah. So I've been investing for about 5 years now. I've been interested in the markets a little longer than that, but and I've been doing research into the markets a little longer, but in terms of actual money in the markets, about 5 years now.
Okay. So,
Yeah.
what inspired you to write this book?
Well, I think there was two things. The first thing was the GameStop kind of craze, the GameStop revolution, as I refer to it, or the meme stock revolution, as I refer to it in my book. But that kind of whole speculative bubble, and not necessarily speculative bubble, but the craze that happened in the way in which the stocks were able to jump to such extreme overbought scenarios, which they were so inflated, the prices were so inflated, was a scenario in which I had seen back in the cannabis in the early days of the Canadian cannabis market, when you had these companies jumping up, 300-400% in a couple of weeks. And this was, something that I was able to make money in back in the early days of the Canadian cannabis rush. So that was basically back in early 2000s or late 2017, 2018, when we got the kind of word that legalization was happening. And a lot of these companies that were going to be going legal were going to be, supposedly making all this money. So you had these companies' stocks going from, 50 cents to $1 to $2 to $3, and it was just crazy, especially because none of these companies had actually made any money, or were not actually in even operation. In some cases they didn't even have a facility built out. I remember this one company, MYM Nutraceuticals, which was a company that I had invested in, one of the first companies that I invested in, I should say. And I bought their stock at 40 cents and it went to like $2, and I was like, whoa, what is happening? So, I was
Did
able
it
to
have
make
a
money.
product, a facility, and it was just an idea?
It, it was basically just an idea of what they were going to do and how they were going to do it. They had land that they had planned to build this facility on in Quebec, in Laval. They had, the ideas of like building like this cannabis museum, this kind of history of cannabis. They were going to be kind of building these vaults of seed banks. They had all these ideas and these things that they were, these kind of really cool ideas, but really no way of generating any income from them. And that was something that, I talk about it a lot in my book, that you got to realize the difference between speculation and investing. And at that point, what you're doing is you're speculating, and I was speculating, and I didn't really realize it at that time. And it's something that I kind of break down in my book, is that when you're investing in companies that have no revenue or no real way of making any revenue in the next few months or the next year, per se, then what you're doing is you're investing in an idea, right? That they will be able to do this, or that the idea alone is worth that much share price, or that much value in the company. The company is actually worth that much. But in many cases, that doesn't happen. Like you look at a company like Tesla, right? And it's like they have this idea that with the revenues they have today, their stock price is not nearly worth, what they're making. So like the idea is that the technology that they have is worth way more than the revenues show at the current rate. So in a few years, their revenues are going to grow substantially, and this justifies their high share price. So that's kind of the thing you're working with in a lot of these speculative stocks. Like you look right now in the magic mushroom industry, space, where you look at companies like MindMed, companies like Numinous, where their stock price is going, upwards of $3 when they really have no revenue. They really are not generating any substantial revenue, but yet people are jumping into them. And I have even thought about investing in them, and I don't recommend people necessarily jump in right now, but I think that it's a space that is certainly a good idea if you want to jump into some speculative plays for the next 5 to 10 years, right? It's certainly an interesting place to be, but just like cannabis was back in 2018, you're going to see these bubbles and these stocks that are getting shot up to such high valuations with no real justification for the share price at those share prices, right? So there's no reason that a company with no revenue should be trading at $2 to $3 a share, right? It just doesn't make sense. You're talking about like a company that should be generating 200 to 300 million every quarter, and they're not even making any money. So you need to understand that when you're starting to get into some of these plays. And that's kind of one of the reasons why I wanted to write this book, is because I was able to generate a substantial amount of money, upwards of $40,000-$50,000 from the big Canadian green rush back in 2018. But then I was able to, or I should say, unfortunately, I ended up losing most of that money. Not all of it, but 20 to 30,000 of it, I certainly I watched slip away as a lot of these bubbles burst, right? And you kind of see in a very short period, a lot of those gains or a lot of those share prices just evaporate. And that's what you're going to see with stocks that don't have any revenues, but are being shot up by these speculative, whether they're being pumped by the media or by Wall Street bets or by whatever catalyst is pumping them. If they don't have enough revenues, or they don't have any ways of generating any substantial revenues, they're not going to be able to sustain as a company. So that's one of the reasons why I wanted to write this book, to kind of give early investors a way to look at the market and a way to understand the difference between speculation and investing. And if you look, like I said, when you go down to the table of contents here, you can see the very first chapter is called Speculation versus Investing, right? And so that's where it kind of all starts, is
So
by being.
should we be looking more at getting away from speculation and going more for more solid projects?
Well, I think that's something, what I do break down in this chapter is not necessarily to encourage people to do that, especially younger people, but it's to understand the difference, right? It's not necessarily that you shouldn't be speculating, although you should never be speculating with money that you can't afford to lose, right? That's number one, and that's absolutely the key that most people need to understand, is that's you can't look at it like this is a lottery ticket and you're going to put all your money into one stock and you're going to become a millionaire. That's almost never going to happen, right? But what you can do is, if you can look at speculating as a way to approach the market with the idea that, okay, I'm going to put $500 here. It's a speculation, so I'm not planning to make a ton of money, but I also I'm not going to be totally hurt if I lose that 500, because really what you're looking at is a way to turn that 500 into maybe 2,000 or something, but also the probability that you might also lose all that money. So you need to be able to outweigh the risks, right? And be able to understand that with speculation, especially if you're looking at long term. If you're looking at short term, then a lot of times you can mitigate that by maybe putting in a stop loss by saying, okay, I'm going to buy the stock here at $3, or maybe at like 310 or something. And if it breaks down below 250, I'm going to get out. I'm just going to sell, and I'm going to take like a couple $100 loss rather than losing a few thousand or 1,000. Right. So that's something I talk about too. Right. Like, one of the things throughout my book is kind of to make people understand how you can mitigate the risks of speculation by being able to understand the markets, by being able to understand the stocks you're getting into, and by being able to understand things like support and resistance, and how you can use those to your advantage to then be able to speculate, but without putting all of your assets at risk, or without putting yourself in a position in which you're going to be unable to get out of your trade, or to know what to do in that situation, whether you want to sell at a certain resistance level if it's not able to break through, or if it goes down to a certain support level, you'll know maybe to add to that position, or to get out if it can't hold that support level. So those are kind of things that I kind of break down for you, and it works for crypto just as much as it works for stocks as well, right? So the first chapter I kind of already gone through. That's the big kind of idea, breaking down the difference between the two, and understanding that the people that have less money, so if you have only a few, maybe $1,000 to invest with, you're probably going to want to speculate, because the idea that you're not going to be able to put $1,000 into like a Google or something and generate a crazy amount of money. It's just not going to happen, because for Google to double, for you to generate $1,000, Google is going to have to go up like $1,000 or whatever Google is. It's going to have to double from that price, and for it to do that is probably not going to happen in the next year or two, right? So if you are wanting to generate more money, and you have like $1,000 that you can afford to lose, but you also want to maybe turn into a couple thousand, or 5,000 or something, if you wanted to get 200-300% gains, you're going to have to speculate. You're not going to be able to do that with dividend investing, or with putting into these very kind of low risk investments like a Google or an Apple or a Microsoft or something like that, right? Or
That's
even
why these crypto things are, I guess, very popular, right?
well,
Because they're very speculative, and you can make a good amount of money getting in there, right?
absolutely, yeah. I mean, that's the thing, right? Like crypto, you can generate the same amount of percentages that most people generate in a year. You can generate in a month easily, or in a few days, even most times, right? So it's really the risk is just heightened in that sense, right? When it can go up 30-40% in 2 days, it can also go down 30-40% in 2 days or a day, and that's kind of the thing, right? Is with high reward comes high risk, and that's one thing to understand about the difference between speculating and investing. Is typically speculation is much higher risk, but also much higher reward, which means that you need to be able to afford to lose what you're able to put up, but also understand the position you're in, and understand that if you're going in, you need to have a plan. When you're speculating, you need to have a plan. If you're just dividend investing, you can kind of just throw money in and just leave it and just never worry about it. Like I bought Canadian Tire stock like 2 years ago, and I haven't even thought about it, and I don't even plan on thinking about it for the next. You know what I mean? Like it's just not. I don't even care. You could tell me that it's gone down $50, and I wouldn't even care. You know what I mean? Like because it just pays me dividends for holding it, and it's just I'd buy more. If you said it went, it's like I'd be like, oh crap, it's a good time to buy. I'm gonna buy more, because that's just the goal of it is
More
not to not.
established. It's even
Yeah,
something I use almost every day, let's say, or like
yeah. Like I go down if I'm gonna get like something for my house or something for the garden. It's like, okay, we're gonna go to Canadian Tire. It's down the street. They got gas stations. Like they're in almost every business. They're one of the biggest sports distributors. They are the biggest sports distributor in Canada. I mean, it's just undeniable that they are a staple of the Canadian economy, and
they
it,
basically become essential for the in our
yeah.
current economy as well, right?
Yeah, absolutely. So that's the thing, right? Like but I bought the stock when it in the during the pandemic, when everybody was panicking and the stock was tanking, went down to $100 from 150 when it was 150 before the pandemic, went down to 100. It went down to like 90 and I bought it at 100, right? And then it went to 200, right? And then now it's like now it's sitting around like 200 or something. I don't even know, right? I haven't looked at it for like months, but I don't care because it's just paying me money for owning it. I just get like, every few months I get like $50. So every year I get like a few $100 just for owning it, the stock, right? And that's the goal of it. It's not really to buy and to sell after I get like 100% because I've already made 100% in terms of the stock price alone, right? But it's not about that. It's about owning for the next 10 years. And Suncor is a very similar play, which I have in Petro Canada. It's the same thing. It's the same idea, right? And that's just a gas play. Now that's a more short term because I see gas. I don't want to be holding gas after the next 5 years, but I still think gas is definitely going to be a thing for the next 5 years or 10 years. So I want to definitely be holding gas for at least the next few years. But anyway, that's the first chapter. The second chapter, patience is a virtue. So that, and then here you're not going to see that because it only gives you the first chapter in the preview here. But the patience of a virtue is really just understanding that your biggest tool, your biggest asset will always be patience. Will always be the fact that you don't have to trade. Like the difference between you and Wall Street is that Wall Street has to trade. They don't have an option, right? Like they go into work, they have to make trades. They
That's
have to
their job.
buy stocks when they're high. Sorry.
That's their job. They
Yeah.
go there to get in, get out, and move around, move the market, right?
Yeah.
Opposed
Exactly.
to
So
the common person, I guess. How you're saying you don't have to be trading every day. Everybody has a different strategy, I guess.
yeah, absolutely. And find your strategy. Find what works best for you. If trading every day works best for you, then do it. I don't recommend it because you're almost always going to lose because the market is not a straight line. It doesn't move in one direction. It typically moves in a million directions in every different way, and it wants to fake you out. It doesn't want you to succeed, and that's one of the reasons why being able to have a plan, it will always allow you to succeed more than somebody that doesn't, because the market, you can get lucky and buy GameStop and it'll go to 400, and you can do that once or twice, and maybe you can do that for a career, maybe, but almost nobody's going to be able to do that and do it successfully. The idea is that you need to understand charts. You need to start looking at charts, understanding levels, and start to be able to buy at those levels when things are at good prices. You need to start to understand what's overbought, what's over, what's under, what's underbought, what's being oversold, and being able to buy things when they're cheap and sell them when they're high. And that's the thing: buy high, sell low. It's like, or buy low, sell high, or sell high and buy low, depending on if you're shorting or if you're going long. And I talk about that too, right? I talk about short selling as well, not just about going long as well, because there's two different strategies, and I think people should always understand that. Some people are just better short sellers. Like me, I'm a better short seller when it comes to short-term trading. I'm a much better short seller because I can look at stocks and be like, okay, this should not be at this price, and so I can predict it's going to go down a lot easier than I can be like, this thing is at a low price. It should be at a much higher price, but I don't know when, right? So a stock I invested in earlier this year, which is a purely speculative play, is called CFRX, Contrafex, and they're like they deal with like what do you call it? In hospitals, they have one of the biggest causes of death is infections after they do surgeries. So what they deal with, Contrafect, is their biggest product right now, is a product that will almost eliminate all infections in hospital surgeries. So it's a product. I'm not sure if it's some kind of adhesive or some kind of spray or some kind of drug. I'm not 100% sure what the actual application is, but basically what it does, if it's approved and if it actually succeeds at trials, is it will eliminate all deaths due to infection in hospitals, which are, tens of thousands of deaths every year. So this is would be huge, and it's a very speculative play because they really don't have any money. They don't have any revenues. They're not doing anything crazy. But if they get through on this drug, and I only have a few, maybe $500 in the stock, right? But like if they do get approved, it'll go from 4 to 8 to 12 maybe, right? And I'll triple my money. Maybe I'll make 1,500 out of it. And maybe I'll put in a few hundred. If it does go up to 6 or 7, I'll throw in another couple hundred, and then maybe I'll make 1,000 out of it or 2,000 out of it, right? But anyway, that's just understanding certain things, right? Support and resistance, understanding, researching a company, researching what the company offers, and if these speculative trials get approved, then obviously what's going to happen, right? So you're speculating because they could also get denied. These trials could fail. And if these trials fail, then the company's stock is not going to go up. It's going to go down. And you need to understand that. So if something comes out and the stock goes down 20%, and it's like, oh, all these trials failed and they have no chance, then you're going to want to get out, right? And you're going to want to take that loss, whether it be $100, $200, whatever, right? And just know that, hey, I tried, but I'm going to save the rest of my money for a better play, right? So anyway, patience, and that's patience, right? A lot of times that's patience because you're waiting for those times, you're taking the time to do your research and finding those good plays, and understanding that you don't have to trade. You don't have to make those trades. You can wait for the best price. Wall Street doesn't have that option. Wall Street has to buy at the highs, and they need to sell at the highs, right? They don't have the option of not trading. You do. So that's always going to be your greatest asset as an individual trader, as a retail trader, as they would call you. It's always going to be your greatest asset. So anyway, the next chapter, invest in the best and trade the rest, is kind of what it says. You want to be able to, especially if you're investing and not speculating, and that's the difference, right? If you're investing, you invest in the best companies. So you invest in the ones that are on every street corner, the ones that are guaranteed. So another thing I talk about in this chapter, and it's a very important thing, I think, for most people that are just average people, but that are paying bills and that are constantly having to put money into these giant utility companies, is to research your utility company, right? So if you're paying a company like Enbridge, right, you're paying them thousands of dollars a year for gas or whatever, you should then invest in that company and get dividends from them. So every few months, those companies will pay your bills for you, right? So I'm gonna put $2,000 into Enbridge, and every 3 months I'm gonna get a $200 check in the mail, right? So if my gas bill is $50 a month, then guess what? I just paid all my gas for those 3 months, or those 4 months is all paid by the company just for owning their stock. And if their stock goes up, which it probably will because it's a gas company, their stocks don't really move because it's more a dividend play, right? Then it goes up and you make money from the stock going up. So in the next 10 years, if it's going to double, then you're going to make money from that, and you're going to get paid dividends for holding the stock. This is investing in the best, right? You invest in the best and you trade the rest. So when you're trading a stock, it means you're not holding it for long term. You're buying it today and you're selling it in a month, or you're selling it in a week. You're selling it in 2 months. You're selling it once you've gotten enough profit out of it. You're happy and you want to walk away, because you're not thinking this is going to go forever. You trade GameStop. You don't invest in GameStop.
Because you don't know where it's going.
Yeah.
Yeah. Okay.
And you don't know what the top is. And if you're speculating and you know that the amount of money that they're generating doesn't justify their share price, there's no reason you should be holding a stock once you've already made 50% or whatever, right? Once you've already made good money, get out and maybe hold a little bit, 20% of your, just in case, but then get out once you see the warning signs. So the next one, sector sympathy, is basically the idea that understand sectors and how they move together. The electric vehicle sector, the cannabis sector, the crypto sector, all these sectors move together. So if crypto goes up over the weekend, more than likely on Monday, crypto stocks are going to go up. So Mara, stocks like Riot, these blockchain stocks are going to go up, more than likely on Monday, because they go up if Bitcoin goes up, right? So understanding sector sympathy. If EV goes up, if Tesla goes up on Monday, if Tesla jumps 30% on Monday, then you're going to bet that a stock like Neo, Xpeng, or even Fisker, some of these other EV plays are going to probably jump too, right? So that's just understanding that if Tilray is going to go up, is going to jump 20%, then you can, if you get up in the morning and you're going to trade or you want to invest for the week and you're looking at cannabis stocks and you see Tilray's up 20% today, and you look at maybe Aurora, or you look at Canopy, or you look at, maybe some of these US plays, and they're not up at all, you can maybe buy that stock and catch that same sector sympathy, right? And then get that, because sometimes they'll move slower than the bigger plays, right? And sometimes you have sorry.
That's an interesting strategy. Because I definitely knew that about crypto. Like when Bitcoin goes up, doesn't matter what happens to every other coin, they all move up, right? It's kind of like the tide in the wave.
Yep. Yeah. Everybody
I never
follows
really
suit.
knew that kind of went the same way with the general stock market.
Yeah, it absolutely does. And I mean, it doesn't always correlate, but almost always, nine out of 10, the stocks are going to move in sympathy, right? So that's sector sympathy, is just understanding that, and understanding that if if Tesla's moving 30%, you could probably get 10% out of Xpeng in a day. And that's more for trading, if you're going to be trading. If you want to be investing and you're looking for long term, then it just gives you a sense of maybe when the market's going to change, or times you can get some quick swing trades, and understanding that the sectors do move in unison. So if there's a big sell off in a sector, then maybe that's a good time to get out, right? Is another thing too, is just understanding sympathy goes both ways, right? It goes up and it goes down. And they follow suit generally. So that's sector sympathy. Never trifle with the market cycle is kind of the idea that you don't want to fight what's happening, right? So you kind of want to trade with the market, trade with the trend. The trend is your friend. That's typically a big saying that goes along with trading. Investing, it kind of works the same, but for investing, for the most part, if you're not speculating, then you're going to have faith in the company. And if you have faith in a company, then what you want to do in a downward cycle, say, and you want to buy a company, is just wait until you think the market's bottomed and then start loading up on the stocks you like. Wait for the big crash. And then that's what I did with Canadian Tire and Suncor. It's like, wait for the crash. And then when you think it's at the bottom, just start buying the stocks that you like, right? And if it keeps going down, then just hold them and know that eventually it's going to go back up, and eventually it's going to be back to higher places than it was before the crash, right? So that's kind of, there's definitely other things that I talk about in there that are definitely more nuanced, but for in a quick rough sense, that's kind of the idea. Is you just don't want to fight the trend. If you think the market's going to be going, if you've had a big long uptrend, you probably want to either exit your positions or just know that they're probably not going to go up for much longer. You're probably going to have a downward trend. And maybe if you want to get into a short position, that's a good time to enter. But it's just understanding this, once you understand the cycles, then you're going to understand that, there's times to trade. Like for instance, right now you have summer trading, so you have a lot less volume in the markets, and that's the cycle, right? The cycles go from times when you have a lot of volume in the market, a lot of traders, which are typically in the wintertime, in the fall, and sometimes in the early spring. But once you get late spring, summer, people are out vacationing, people are at the beach. You don't get a lot of volume, so it's not the greatest time to trade, and you're also not going to have a lot of big moves, right? So just understanding that. And sometimes you also get
the term sell in May, walk away.
Yeah. Sell in May, go away. And that's yeah. And that's saying don't trifle with the market cycle, right? Don't try and think you're going to make tons of money in the summer, right? Because you're probably not. that's a time when the market basically is just going to trade sideways. So yeah, understanding that, and don't trifle with it. Just respect it, right? But if you see the market starting like in 2020, when the pandemic happened, nobody was traveling, nobody was going anywhere. So you actually had more volume in the market in the summer than you ever had before, right? And that's another reason why it's okay. Well, then I guess I'm going to trade more now and understand the
Yeah, I
cycle,
definitely
right?
think a lot more people got into trading, right? A
Yeah,
lot of
they
people,
did.
yeah.
Yeah. For a short time, they didn't last for very long, but they certainly got in. um, That the problem with trading is that people overtrade. It's simple as that. That's why I say, like, you don't always have to trade, and understand that patience is a virtue, and patience is what will separate the great from the good, right? And you want to be a great investor. You don't want to just be a good investor, right? And really, patience will separate the successful from the unsuccessful day traders. And definitely, it's definitely not a game you can win if you want to make money quick. Just say that. Um, so chapter 6, eat my shorts, is basically breaking down short strategies. So that's my kind of chapter where I really give people my understanding of short trading and why I think it's necessary for the markets, but also a good thing for the markets, and also why I'm more of a short-term trader, and I find myself being a more short bias trader myself, especially when it comes to like shorter-term trading. Longer-term investments, obviously, I think going long, like buying, and selling, is definitely better. But for shorter term trading, I think I see shorting is just a lot easier. It's a lot kind of better to understand where stocks are going to top rather than where they're going to bottom, or whether good times to buy. And that's mostly because the best stocks to buy are generally never at good prices. And that's kind of like why, right? That's one of the main reasons why shorting is so easy, because typically shitty stocks, it's easy for them to be at overbought prices. So it's easy to see when they're good to short. For instance, there's two companies earlier this year that I was very, very much interested in shorting. I never took the shorts, mainly because right when they were at their heights, I ended up starting my new job. So I didn't have the time to kind of watch them for more day trading. But they were called, one was ALF. It's not a terrible company. They focus more on like technology for like AI driving and stuff. And they had given all these tablets to like 10,000 Uber drivers in Florida. But the company doesn't really generate a ton of revenue, and the stock went from like $4 to $7 to $8 to $10 to $14, and it's like this company's not generating millions of dollars in revenue. They're not generating any revenue, really. So it's like it just doesn't justify it. So I was like, this stock's going to go back down to like $7. So I want to short, but I didn't know that was going to be the top, right? So I didn't enter a position, but let a little. And then I was watching another stock ride. It's a EV company as well, Lordstown Motors, kind of an early stage EV company in the States. But it was kind of the same thing. Their stock went up to like $12, $13, and I was just kind of like, this thing's going to fail. And lo and behold, it went back to $7, right? And that's just understanding that they're not generating any revenue to justify their share price. That's just hype. It's just people saying, oh, the stock could be something in 5 years, so I'm going to buy it now. And then realizing in a few days that, hey, I've already made 20-30%, doesn't look that great, so I'm going to get out. And then the stock tanks, right? So a lot of times shorting is more a game of understanding where companies are being overbought, and they're being pushed up to levels that are unsustainable. And
Yeah,
that's,
right there, you're just basically doing the research of the company and
yeah,
seeing. It seems like you're highlighting that um, they're actually not making money, right? Their stock
yeah,
market's actually going up, but it's not. It's not a profitable company yet.
yeah. And really, like, what are they gonna like? That they don't have like they came out with they bluntly came out with a statement that said we don't have enough money to actually operate for the next 5 years. They literally said that. And they're like, the only way we're going to generate enough money to operate for the next 5 years is if we get it from investors. So that's basically saying that like they're screwed if they don't get investors to bail them out. And that's not a good position to be in for a company, right? Especially like an early stage EV company when you have competition like Tesla, like Neo, even like General Motors or Ford, which are billion-dollar companies, right? So that's the thing there where you just need to understand that if you're getting into a game like that against players like that, same with the cannabis space today. There's spaces that you're probably not going to win unless you have huge backing, financial backing that is. That's shorting. Really, there's a lot more to it, but for brief purposes, that's kind of the idea. And the idea is that shorting can be a very profitable strategy for those that can understand it. And it's also a very good strategy. You can build some very profitable strategies. You just need to understand where you want to look, at what kind of companies you want to look at and kind of when their stocks are being overvalued. And then just kind of understanding where there's resistance and where those levels are kind of being built. And then if you can get in at those levels and kind of hold for a few weeks or a few months and, or a month, generally you don't want to be holding forever, but with these times, it's generally anywhere from a week to 2 weeks, where their stock will get shot up generally for a week or two, and then they'll fade for a few weeks, right? So you got to be, sometimes you don't know, right? And that's the thing. You can't shorting, you can lose a lot more money than you can make going long. So it's a game you need to be very, very careful at. And it's something that is only for those that have more money, I would say. That's the thing about shorting, is that it's really only for those that have like a substantial amount of money to be able to invest with, because you need to be able to have that money tied up for a little bit of time in order to generate the amount of money that's needed to justify the investment, right? So a lot of times with shorting, that's why I say I explain that a lot of times too. It's one of those things where it's kind of like speculative investing in the sense that, and you require a margin account to actually be able to short. So this requires a whole different level of, being able to trade with margin, which makes it a lot more risky, a lot more, you'll lose a lot more quicker if you're not careful. So let's just, leave it at that. And so the next chapter, GameStop, AMC, and the meme stocks revolution, is really just giving a history of the craze, the meme stock craze, and the kind of how it started, Wall Street Bets, kind of the rising of Roaring Kitty YouTube channel and Keith Gill, how he was, pumping up GameStop from way back on through Wall Street Bets and through his YouTube channel, and how kind of the whole movement started and how it progressed through AMC to AMC and to all these other names like Costs and Jan and some of these other stocks that were just pumping in Sympathy, right? You could say, in sector Sympathy. So that's really what that is. I give some historical antecedents that kind of led up to those things. So like the creation of the futures market, tulip mania in Dutch, in the history of Holland, kind of led to the creation of the futures market there in trading tulips. And that was kind of a speculative market that led to like a speculative bubble where tulips were basically being sold at astronomical levels. And they were never actually the tulips, they were contracts to buy these tulips. So it's just the idea of speculation and what when something becomes extremely overvalued that really has not, the actual thing itself doesn't have that value. It only has value because people are willing to pay that amount of money for it, right? So with tulips,
Still continuing?
Sorry?
You see this still continuing, or do you think it's gonna kind of wind down and kind of stop, or do you think it's
Like
just like the meme stock stuff? Do you think it's not keeping up with that any as much, like the Wall Street bets, right?
Yeah, well, it's kind. I mean, it is
You
still
definitely
happening. Like,
continue.
for instance, like there was a recent IPO with Robinhood. So Robinhood, the big like investment trading app, like they just had a big IPO, and it was kind of the same thing. Like the stock kind of had an IPO, didn't do very well, kind of got beat up for a couple days, and then it started getting pumped on Wall Street bets. The next thing you know, it went up like 100, 150% in like a couple days, right? And that was like last week. So now, like, you know what I mean? Like it's cycle. It's all about cycles, right? And that's what I was saying. Like it's understanding these cycles and understanding like it's not necessarily just Wall Street bets. It's there. Some of these things have legitimate, things behind them. Like GameStop is a legitimate company. They're making money. They have plans for how they're going to survive. AMC is a legitimate company. It's some would call it a reopening play, right? Like they do have thousands of theaters throughout the U.S., right? Like they're not shitty companies. They generate millions of dollars in revenue, right? Like these are different from a pure speculative play, right? Because they do have some fundamentals behind them, right? So that's in that sense, I would say that it's not completely done, and that there will be more pumps. There will be definitely more moves to be had in those stocks, and they might not necessarily be all unfounded. Some of them might be being happening because of actual fundamentals, like they're able to turn their businesses around. They're able to find new methods of generating substantial income. Maybe they get into esports more. Maybe they start to push certain things that help them to generate more revenue. Maybe they just with reopening, they're able to get back up to where they were before, pre-pandemic. There's lots of things that could happen for them that could turn them into good plays, right? So you can't just discount companies because they come fallen on hard times for a short period of time when they've been good companies for a decade, right? Um, but certainly I wouldn't be buying those stocks at $100 a share, or even $50 a share, right? I'd certainly want to be getting them at extreme discounts if I am going to be investing in them. Um, yeah, so that's kind of basically what I break down there. It's pretty much what I just said there. And then chapter 8, be persistent, finding support and resistance. So that's kind of the idea that like you need to understand support and resistance if you're going to be successful. In the long run, like you can, if you want to just buy dividend stocks and hold them forever, you can kind of buy wherever, and it doesn't really matter, right? Because those stocks don't really move a lot. They're not crazy movers. You're really just getting in them to have them for the next 10 years, which they're probably going to be way higher than whatever price they're at now in 10 years anyway, right? So it doesn't really matter to look for good levels to buy, because you're probably not looking to sell them anytime soon anyway. But if you're looking for especially with speculation, but also with like more medium risk investments where you're maybe not looking to generate a ton of dividends, but you are looking for it to slowly go up for the next few years, you do want to understand support and resistance, right? These are levels in which people are confident to either buy, which are support levels, which they're looking to kind of hold up if the stock starts to go down. These are levels people want to defend, and levels maybe you want to get in as well. Resistance are levels where it goes up to usually levels like $100 or $150. It'll hit those levels and then it'll reject, and it'll have a hell of a time trying to break through those levels. And typically it's because those are levels that are showing you where it should be. It should be trading at those levels, so it's probably not going to go up much higher than those levels. So people are not confident buying it above those levels, which is why they'll go up to those levels and just sit there, because that's where people are selling. Oh, yeah, I'm going to get out here because that's as high as it's going to go, right? And so they form these levels in which people are either confident to buy at, which are the support levels at the bottom, or the places where people are confident to sell at, because they feel like that's going to be the top. And so that's why you get these clusters and these times when the stocks kind of just sit in these levels. It happens in crypto quite a bit, right? Like they'll just sit in these ranges, they'll sit in these levels, and you can see, and what happens is that once a resistance level breaks, that level will now be support, right? So if it breaks, say 1,000, so if Ethereum breaks 1,000, right, it goes up to 1200, then it comes back down. That level of previous resistance at 1000 is now going to be support. So that's going to be where people are going to be buying it now, is that $1,000. They're going to be getting it at 1000 because they know that it broke that level before. Now it's going to act as a level where people are confident to buy at, right? So that's kind of just what that's breaking down. It's breaking down these levels, and I give lots of charts. So you can see here, if you're looking at the chart here, this is a stock GHG that I traded way back, but I give charts like this, and I show people kind of levels of support and resistance. Like, so you can see this down here, this cluster, it's trading at like 2 cents for the longest time, or I think this was maybe 7 cents or something like that. It's trading at like 7 cents for the longest time, right? And eventually it broke through that level, right? And when it broke through that level of 7 cents, I knew to get in. So I bought it at 8 cents, right? When it broke through that resistance level, right? Because now it's support. So then you hold through that big push. And once it kind of maybe is able to, consolidate and push again, I'm getting out, knowing that it's probably extended. Now it went up way higher than where I sold it at. But that's just me saying, okay, it's pushed twice. It's already broken through another resistance level. Now I'm confident to take my profits, my 100% gain, and walk away. But I left some money on the table too, right? Just maybe it'll keep going up. Maybe it doesn't, right? But you always want to be able to take your profits and get out. And that's something to understand by support and resistance. It's just being able to get in, get out at those resistance levels, and at least with 75% maybe. Keep 25% in, but already made profit. Take everything you made out and your gains, right? And then leave a little bit behind just in case. So the next level, the next chapter, brokers, profits, and stop losses, is basically talking about where you should look to invest, what which brokers you should look to trade with, which brokers you should look to avoid. Basically, it's find a TFSA if you're in Canada, find an IRA if you're in the US, basically a tax-free vehicle. So being an investment account, which you can put money into and trade tax-free. So the only time you're going to pay taxes is when you take money out of that account. And so I don't really recommend doing that, especially for a young person. And if you really need it, then yes, take money out. But if you're investing for your future, just put the money in and keep it there, and keep investing, and buy, sell, but always just keep it there. And that way, the only time you're going to pay taxes is when you take it out, right? And other than that, you really want to understand how much you want to trade. If you want to trade a lot, then you're going to want to find a broker that charges cheap commissions. So Quest Trade is probably the best one in Canada. It's one I use for day trading. But if you don't really care about day trading and you're just looking at investing for the long term, and you're not going to be trading every day, maybe not every week even, using your bank, getting a TFSA through your bank and paying $5 a trade or whatever is fine. It's never gonna, it's not gonna kill you. It's probably the better way to go. Or even if you want to go with Wealth Simple and get, free commissions, it's fine as well. I don't recommend Wealth Simple for day trading, but it's fine if you want to hold a couple stocks there, if you want to start there and put a couple $100 in, and just to see how investing works. It's absolutely fine. I just don't. To me, like the charts and the different executions that you'll get on something like Wealth Simple are just not as good as something like Quest Trade or something like Investor's Edge through CIBC or whatever bank you have. You'll get better executions through them, and yeah, you'll pay a little bit more, but it's not going to ever be enough to break the bank, especially if you're only trading a little bit. If you're trading every day, then yeah, you want cheap commissions. So you want to use a broker that that you can basically pay nothing for your trades. But for the average person getting in, they're not looking to day trade, and they certainly shouldn't be. They should be less looking to just, yeah. And so the next one there. Oh, and I also, in chapter 9 is also profits and stop losses. So that's kind of understanding where you should look to take profits. If you're going to be up a certain amount, whatever your target is, you should always take profits. You should always pay yourself. Even if you think it's going to go to the moon, you should still take profits, because you never know. It might not, right? And the number one key is that with investing is that you can always be wrong, and make money, but you can always be right and make money, but it's when you're wrong, um, that's when you're really going to suffer. So it's good to take profits when you have them. And I don't mean like 10, 20%. That's not really, but if you're getting 50% in any trade, I almost always recommend at least taking some money off the table. So that's the profit and stop losses basically. And the last chapter,
right? Like,
sorry.
that's kind of, I see that's like the challenge a lot of people face, right? They see this thing going up and up, and they're like, oh, oh, it's gonna keep on going, it's gonna keep on going, and they don't take those profits. And this is like kind of like in my situation, right?
Mhm.
You think it's just gonna keep on going up, or you're, oh no, it's gonna get this target, and then all of a sudden, it's not what you thought, right?
Yep. Yeah, same thing in cannabis for me. I mean, kind of in crypto too. I mean, I saw Ethereum hit like, well, Canadian dollars, 5,400 or something like that, and I bought it at like 1,700, right? And I sold some at like 4,800. But I basically watched it go from 58 back down to like 2,000, right, within a couple months, and it was like that was like literally lost like probably like 1,500. But like I was always knowing it was going to go back up. But like it's just when do you know when to sell and when to buy? And I sold like maybe 500, 600 or something when it was at 48. But it was like, how much money do you sell, right? How much do you take out? You got like two or three grand profit, and you're like, well, with crypto, if you're buying it for the next 5 years, it's like you don't necessarily want to get out, with just like 100% profit, right? And that's the other thing too, is understanding what you're in. It depends on how speculative it is. The more speculative, the quicker you want to take profits, right? So that's definitely a thing to take into consideration. And the last chapter here is basically I give you my biggest takeaways. It's basically my biggest things you should consider and you should really think about and really put your time into researching and into studying if you really want to be successful. So those are kind of my biggest takeaways, is the final chapter. And some of those are things like what YouTube channels you should look at, finding the right mentors, the right kind of people, finding the people that trade the type of trading that you find successful or you think you can be successful at, learning from them, but not trying to copy them or certainly not following anybody's trades, but just looking at the way they trade and looking at the way they are able to make money, and just understanding patterns and charts, and starting to really study those things. And if you can study those things successfully for a while before you start investing, you're going to be so far ahead of anybody that tries to just jump into the markets, right? And paper trading helps, right? Like if you can paper trade, the problem with me is I just can never take it seriously with paper trading. I never got that emotion that I got with real trading, and it is difficult to
So what do you mean by paper trading? Is like,
so like what you can do is you can trade in a simulator, and this is more for day trading than it is for investing, because when you're investing you don't really need to worry about being able to trade or get in and out successfully or understand patterns as much to the level. I would still certainly recommend you studying patterns, and that's one of the things that simulating and day trading helps is to understand patterns a lot quicker. But just being able to use something like uh, a trading simulator, like even Trade Zero, or no, sorry, TD Ameritrade, so Thinkorswim, they offer like a free, you can just use it, paper trading. Just they give you like $100,000 or something in fake money, and you can trade the markets, right? So it just gives you a sense of what it's like to trade to get in, to buy a stock, to sell a stock, but you're not actually risking any
Or
money.
you actually put money in there, right?
Yeah, absolutely.
So if you get
Right.
wrecked, you don't have to worry about anything, and you actually learn quite a bit, I guess.
Yeah, exactly. Right. And like I said, it's better for shorter term trading, because I don't think um, it really helps for longer term, because obviously those are psychological things that are almost require you to have money involved, for you to feel the emotional or understand the difference. But certainly understanding patterns and charts you can do with paper trading for sure. So it's just the different things that can give you tools that will help you succeed. There's different ways to get there, and there's different ways to understand these things, right? But there's certainly things that can help you to be more successful. And that's what this book is. This book is really that. It's really, here are the tools and here are the strategies and the ideas that can help you to be successful. And here's somebody that's already done it, that's been through these things, that's now in the intermediate stage, that's gone through the beginner stage. And these are all the things that I wish I knew when I got it. And that's kind of why I wrote this, is to give people that advantage that I never had, right? And to make people understand the things that I never understood, and that if I would have understood, I would have been a lot more, successful today. So that's that. And really, um, the book in itself is really my thoughts. It's really my psychology, how I think about the markets today. So what I have learned from my mistakes, and what I kind of, I say something here. It's a little corny, but um, it's like right here. It's like, my journey as an investor has been a rough one, with plenty of ups and downs that I detail in this book. The hope is that you will learn from my mistakes and innovate on my triumphs. Investing does not need to be hard or complicated. The lessons in this book are meant to simplify the market and provide a foundational structure for the development of your investing career. No one can be guaranteed success in the markets. You are responsible for the decisions you make in life. However, or hopefully, this book will help you make the good ones, or make good ones, right?
So
So
we
it's
can
like,
find this book on just Amazon, or do you have it anywhere else?
right now it's just on Amazon. I'm currently working to make like a audio version, so hopefully get that on like Audible. Um, if somebody wants to just listen, then it'll be on that. But I haven't really started it, so I can't really give a date. But yeah, for right now, it's just available on Amazon. I guess we'll put a link in the description below if people want access to it. But certainly, it's good. It's a good place to start if you're just starting out your investing journey, and you really want to get an understanding of how you should start, how you should approach the markets, and what you should where you should look to be as an investor, or how you should look to uh, program your mind, at least. Because that's the big thing about people, is that, like, when they get in the markets, they don't understand psychology, and they got to understand that you got to program your mind to be able to accept certain things, and to be able to always have a plan by understanding support and resistance, and understanding kind of where you're getting in and where you want to get out if things go wrong, or where you want to take your profits when things go right. So that all comes down to having a plan before you enter the trade. And that's kind of what this book is about, is helping people build a plan. And that's kind of, I think, the fundamental thing that people can take away if they really want to have a good fundamental trading plan, and they're just getting new and they don't know where to start. Then this will kind of give you that plan and help you to overcome those initial psychological hurdles. But yeah, so Amazon is where it's available today. Hopefully Audible soon. And yeah, maybe other places. I think Google Play or Google Books, you might be able to get it, but it'd still be just through Amazon.
Okay, awesome.
Yeah.
I'll
And you
definitely
said,
put a link down below. And as you can see, you can probably get just a Kindle version and a paperback version. Um, Thanks, Mike, for sharing that with me.
Yeah, for sure, man.
So
Anytime.
before we wrap this up, I would just want to have your thoughts about the market, how it is currently, both
Sure.
like the U.S. stock market and maybe if you want the Canadian because that's where we're located, and then a little bit of your thoughts of the crypto. It just started to kind of come back up again.
Yeah.
I wanted to
Yeah.
hear what you think is currently happening. What are your short-term thoughts about these markets?
Sure. So, as I kind of said earlier, summer trading in the U.S. markets and Canadian markets as well. So the overall stock market right now is pretty quiet. There's not really much going on. It's kind of been chopping up around the top. So we had like a breakout the last early, few months of the year. We had a breakout to the new highs in the stock market, and then you kind of, fell down, hit resistance, and now it's kind of just chopping around the top. It's not really doing much, and you have a big kind of a big sell off happening, but it's really just the market not finding buyers. There's not really a lot of volume because it's the summer, right? So there's not a lot of traders, not a lot of people there to step in. So right now it's kind of just chopping around. There's not really a big, it's not really going huge down, but it's not really going huge up. It's kind of just doing nothing. So that's the stock market in general when we're talking about the U.S. and the Canadian market. But like you said, that's going with the old adage of sell in May and go away. It kind of makes sense. Typically, people don't come back until September, late September, usually. So that's when probably we'll see the markets pick back up, and maybe we'll see a test of the highs, and maybe we'll see it break out, right? Especially if we don't see any new lockdowns or anything like that, right? As long as we don't see anything on that front, we should see the markets breaking out to new highs, and we should see a pretty good end to the year, as long as we don't see anything on the front of you know any of that. But also, like the other thing is that because we're already at all-time highs, we could also see a sell-off, right? Maybe when people come back, things don't look that great, and then we start to see a big sell-off and a panic. And if that happens, then we could get another base before we see another big push to the highs towards the end of this year, going into next year. So those are kind of two scenarios. Yep. But with the crypto markets, I think that you kind of have a better sense of what's going to happen and what is happening, right? And I was saying for a long time, like I made videos on my channel. That's another thing. Maybe we can give a link to my YouTube channel too. So that's my Revolutionary Road channel, and on there I talked about how the crypto markets were starting to and this was way back when things were at the highs, and I said that they're probably gonna bounce, bounce off the highs and then kind of make a move lower until we start to base out for the next move into all-time highs, because it can't always go up, right? Like eventually something's going to go down, especially when you have 200, 300, 400% gains in a year. You're probably going to see 200, 300% losses, right? It's just the way the market works. Nothing always goes up. So you have to predict that, and you have to be able to look at the charts and then be able to benefit from those support and resistance levels, like I was talking about earlier, right? And so I was understanding that 2000 was a big it was earlier a big resistance level, so I was buying at like 1700 back when I was thinking that it was going to break that level, and it did, and that's when it went to like 5800, right? So then I sold a little bit, and then it came back down, and I knew that 2000 back then was a big resistance level, so now it'll be a big support level. So it came down, basically hit 2000, and that's when we had the big bounce, right? And now it's back all the way up to almost to 4,000, right? So it almost doubled from that resistance, from that support level.
What, Ethereum, right?
Ethereum. This is Ethereum. Yeah, yeah. I'm a big investor in Ethereum. I'm not really a big investor in Bitcoin. I don't have any Bitcoin myself. I trade mainly Ethereum, Algorand, Cardano, Cardano and Ethereum are my two biggest ones, and currently Mana is my other holding. So Mana being Decentraland, which is basically an Ethereum token, so it mimics Ethereum's price action pretty closely. And Polygon is another one that I really like, but I really just I should have bought it at like 90 cents when it came back down to 90 cents, but I was really, I don't know. That thing moves pretty crazy. So, but anyway, I still think like Ethereum, all these things are going to be good plays for the next 5 to 10 years. Like when you look at, the way crypto is going, there's countries starting to adopt it as their national currency, like what happened in El Salvador, and you're having these moves around the world where people are starting to adopt crypto in many ways, and probably it's going to be just continuing. But so I really see crypto as being one of those things you want to look to buy. I don't necessarily recommend you buying today at the once it's bounced to the highs. Maybe wait for another pullback, but just understand that it moves in these ranges, right? And understand that if it's gone up, say like since it bounced off that 2000. For Ethereum in this sense, I'm talking about Ethereum, but it works almost with all crypto when you start to look at them in the way they move, right? They move very similar. Sector sympathy, going back to that sector sympathy thing, right? So when you look at Ethereum, it bounced off 2000 and went to 4000. That's a 100% gain, right? If you're in with 2000, you just made $2,000, right? So it's probably not going to keep going up. It's probably going to come down 50%. It's probably going to go down to 3,000, right? So just understand that now you're starting to make higher lows. As it goes up, it makes higher lows, which means it's going to keep going up. And this is what you want to look for, right? You want to look for patterns. So as it goes up, it breaks through 2,000 or it comes down, it hits 2,000, then it bounces up, goes to 4,000, comes down, hits 3,000, bounces, and goes back up. That's making a higher low. It's going, before the low is 2,000, now the low is 3,000, then it'll go in. If it breaks to 4,000 to 5,000, then maybe it comes down, the low is now 4,000 or maybe 3,700 or something like that, right? And it starts to stair step its way up. And that's when you start to read these chart patterns, you start to see these moves, and you can even draw like lines. And I talk about that in my support and resistance chapter, where it's like you can draw these wedges or these lines to align these kind of stair stepping patterns, and how you can see where a chart might go by drawing these lines, right? You can see where the pattern, if it continues, this is where it's going to go as it kind of builds these higher lows, right? So this is a way you can look to justify buying at certain levels, and looking to hold for the next 5 years or wherever, and understanding that when it comes back down to these levels, as these ascending levels, they're good buy levels, right? Because it's making these higher lows. So that's my thought process on crypto anyway. And yeah, it might bounce, it might not, right? If it breaks that ascending line, it'll go down. It will come back down. It might come back down to 2,000, might come back down to 1,000. I don't know. But I just know that with what I'm seeing in the NFT markets, with what I'm seeing in just the overall adoption of crypto in general, and what I'm seeing in the fear from the U.S. regulators, it just seems like crypto is going to be a thing for at least the next few years, if not decades, and something I'm going to be invested in for the next few years.
All crypto, right? There's going to be winners and losers, right?
That certainly, and that's one of the things
with Ethereum, and I have that feeling too, where I think there's a lot more utility with Ethereum compared to many others, and even Bitcoin.
And that's just it, right? And that's just it for me too, is that I see like what I see happening in the NFT market is just, it alone trumps anything that Bitcoin can do, right? Like, and that's not even taking into account all the other applications that Ethereum has. And these are real world applications. They're not just storing your money in some platform, right? Like there are actual things that they can do to help to power markets or power economies or power networks,
And
blockchains.
you actually need to use ETH to use certain applications.
Absolutely, and it's just such a universal thing, and such a um, there's just so many applications for it, and with the ability it has to uh, be so effective at building these networks and at running these networks, it just makes sense that it's going to be the future of anything to do with the internet and blockchain, and if you think these things are going to be the future, then I think that investing in crypto just makes so much sense.